What if I told you that investing a few $1,000s into just 2 ETFs could completely change the way you look at your financial future? That's exactly what I wanted to find out when I started this little experiment, putting $5,000 into SCHD and $3,000 into VOO, two of the most popular ETFs among long-term investors. In this video, I'm breaking down exactly what happened over a year, the wins, the losses, the dividends, and what I learned along the way. Whether you're new to ETFs or already stacking shares, this story will help you see how consistency and patience can work in your favor, and maybe help you make smarter investing choices. Alright, let's dive in. When I started this challenge, I wanted something realistic, nothing crazy, no get-rich-quick nonsense, just two reliable, time-tested funds that millions of investors trust, SCHD, the Schwab U.S. Dividend Equity ETF, and VOO, Vanguard's S&P 500 ETF. These two ETFs represent two philosophies of investing. SCHD is all about dividends and quality value stocks, companies that not only pay investors but also have strong fundamentals. VOO, on the other hand, is the broad U.S. market in one basket, a mix of growth and stability, giving you exposure to 500 of the largest U.S. companies. So here was my plan: put $5,000 into SCHD, put $3,000 into VOO, let them ride for about a year, track the performance, the dividends, and the returns, and then compare. Simple, right? But as any investor knows, even a simple plan can lead to surprising results. I started with SCHD because I wanted to build something steady, a portfolio cornerstone that could eventually generate passive income. SCHD is known for its consistent dividend payments, low fees, and a focus on high-quality companies that have strong balance sheets, and a history of paying dividends. When I first bought SCHD, I invested a little over $5,500 total, rounding out my purchase to $5,573.51. That number stuck in my head, not because it was huge, but because it was meaningful. It was the start of something that I planned to hold for the long term, no matter what the market threw at me. Now, after a full year, here's what happened. Even though SCHD has a reputation for being reliable, my investment wasn't exactly up only. In fact, it went the other direction. My total returns, including dividends and capital appreciation, came out to negative $24.80, meaning I was slightly down. That's right, after a full year, I was technically in the red, but here's the thing: I didn't sell, not even a single share, because long-term investing is all about time in the market, not timing the market. And as long as those dividend payments keep rolling in, short-term fluctuations don't matter much to me. The beauty of SCHD is in its dividends, those quarterly payouts that show up like clockwork, even when the market looks shaky. Over the course of the year, I received 4 dividend payments. Here's how they looked. My first dividend check was $6.59. Second payment was $18.17. Third dividend was $21.40. And the fourth and largest dividend was $43.46. Add those all up, and SCHD paid me $89.62 in passive income for the year. That's nearly $90 for doing nothing but holding shares. It might not sound like a lot right now, but that's the magic of compounding. Every single one of those dividend payments can be reinvested, buying me more shares, which then generate even more dividends next time around. Looking forward, SCHD is projected to pay me $128.50 in dividends this year, which means that even if the share price stays flat, my passive income is growing. That's a good sign that I'm building a long-term income machine, not just chasing price gains. Now, let's pause for a moment and talk about the emotional side. It's one thing to look at charts and numbers. It's another to actually watch your investment go down and stay calm. When I saw my SCHD position showing red on my portfolio screen, there was that moment of doubt. Should I sell? Should I switch? Did I make a mistake? But then I reminded myself, this is exactly why you invest in ETFs like SCHD in the first place, and it's not for day trading profits or quick flips. It's for the long-term compounding effect that happens over decades. SCHD's dividend growth rate and track record speak for themselves. Over time, reinvested dividends can turn a small investment into a serious income stream. That's the power of quality, consistency, and time. 3 words I keep in mind whenever I invest. After setting up my SCHD investment, I wanted to see how it stacked up against something broader, something that represented the overall US economy. That's where VOO came in. VOO is Vanguard's S&P 500 ETF, a fund that mirrors the performance of the 500 largest US companies, from Apple and Microsoft to Johnson & Johnson and Coca-Cola. It's like owning a slice of the American economy itself. For this test, I invested $3,368.40 in my Roth IRA. Now, if you're familiar with Roth IRAs, you already know how powerful they are. You invest post-tax money, and then your gains, dividends, and withdrawals in retirement are tax-free. That's right. 0 taxes on your future growth. For me, that's a no-brainer. I don't want to give Uncle Sam a cut of my future millionaire status if I can help it. This is something I wish every investor understood early on. Where you invest can matter just as much as what you invest in. With a Roth IRA, you can contribute up to $7,000 per year if you're under 50, or $8,000 if you're older. And when that money grows, it does so completely tax-free, even the dividends. That's especially important when you're investing in funds like VOO or SCHD, both of which pay qualified dividends, which usually get taxed at lower rates. But inside a Roth IRA, they aren't taxed at all. Think about that for a second. If you build up $1 million Roth IRA with VOO, that's $1 million, that's 100% yours. No taxes, no surprises, no deductions. That's why I chose to hold VOO in my Roth IRA, because I'm not just thinking about next year. I'm thinking about retirement and the decades of compounding that come before it. Now for the fun part, the results. After 1 year, my VOO investment was in the green, showing a total unrealized gain of $161.24. That includes both capital appreciation and dividends. In simple terms, VOO made me money. It wasn't a massive windfall, but it represented the stability and upward momentum that the S&P 500 is known for. While SCHD had dipped slightly, VOO's broader diversification helped smooth out volatility. And the dividends, small but consistent, and growing. In the past year, I received 4 dividend payments from VOO as well. July 2024, $4.65, October 2024, $7.45, December 2024, $8.68, March 2025, $9.79. That's a total of $30.57 in dividend income from my VOO position. And here's the kicker. Every single one of those payments was reinvested, increasing my share count and boosting my future dividend payouts automatically. Looking ahead, projections suggest I'll earn about $70 per year in dividends in 2025 from my VOO position. That's with no additional investment, but let's be real, I'm not stopping there. I plan to keep adding to VOO for as long as I can. Now, let's stack them side by side. Dividends, SCHD wins no question. With a higher dividend yield, around 4%, it delivers more cash flow to investors. That's ideal if you're focused on income over growth. Total returns, VOO takes the lead. With its mix of growth stocks and exposure to tech, it had stronger capital appreciation over the past year. Tax efficiency, it's a tie, but the Roth IRA gives VOO a huge advantage. Tax-free growth can't be overstated. Volatility. SCHD tends to be less volatile during downturns, thanks to its focus on stable dividend-paying companies. VOO, on the other hand, moves more with the overall market, up or down, so the real answer depends on your goal. If you want steady income, SCHD might be your best friend. If you want long-term growth, VOO is hard to beat. Let's talk about where these investments could go from here. Analysts on TipRanks currently rate SCHD a moderate buy, projecting an average price target that would represent around 15% upside by the end of the year. VOO's forecast is similar, with analysts predicting about 14.9% upside. So, both funds are expected to grow, but remember, these projections don't account for dividends, which could make total returns even higher. Now, to see what this could look like decades from now, I ran the numbers using a compound interest calculator. If I keep $5,573 in SCHD and add $300 per month for the next 35 years, assuming a 9% annual return, that balance grows to nearly $1 million. For VOO, with a starting balance of $3,368, a 10.5% annual return, and just $120 per month invested, that balance grows to $570,000. Combine both, and you're looking at over $1.5 million, from less than $9,000 total to start. That's the power of consistency and time.